Uh, so we'll just have a recap of what we've discussed with respect to pension accounting. So we were discussing in the last class that TPPC, or the total periodic pension cost, was the total cost of running a pension plan in a given financial year, and it was calculated as pension cost reported in P&L plus pension cost reported in OCA. And we had also discussed that total periodic pension cost is the same under GAAP and IFRS, but differ on where the pension costs are reported. Right. So pension cost reported in the P&L So let's look what pension costs are reported in the P&L under IFRS and under GAAP, right? So we said that current service cost was expensed in the P&L, expensed in the income statement under both IFRS and GAAP, right? What was current service cost? Guys, do you remember what was current service cost? Anil, क्या है? What was the current service cost? Anil, सुन रहा है?
Yes, sir. Yes, sir.
So current service cost was the present value of additional benefits that an employee receives by working for one
One more
more
year.
year, right? Then we had the past service costs, right? Past service costs were expensed in the income statement under IFRS, but in GAAP we said that we initially take it to
OCI.
yes, we initially take it to OCI, and then we amortize
Amortize.
it on the income statement over the average remaining service life of the employees, right? And what was past service costs? Past service costs were basically the changes in PBO due to plan
One.
amendments, right?
Right.
Such as changes in the benefit factor. Then we discussed that we add the interest costs, right? So plus, plus, plus. We add the interest cost. What was the interest cost in IFRS? It was opening PBO plus past service costs into discount rate. And in GAAP, past service costs were calculated in a similar manner. Right. So basically, interest costs are the same under both IFRS and US GAAP. Right. So we said that we are adding the interest costs on our plan liabilities, on our pension plan liabilities. Then it makes sense to deduct the income on our plan assets. Right. So we deduct the interest income. And how do we calculate the interest income? Interest income is opening FVPA into expected return. Later on, I'll tell you that IFRS says that the expected return is the discount rate. And under GAAP, interest income is calculated as opening fair value of plan assets into expected return. So if we are adding the interest costs on our plan liabilities, then it makes sense to deduct the income on our plan assets. And interest income is calculated as opening FVPA into expected return under both IFRS and GAAP. IFRS says that the expected return is the discount rate, and US GAAP says that the employer or the company gets to choose the expected return. Right, guys. Now, under both IFRS and GAAP, we are deducting the expected return from our interest cost and not the actual return. Why so, guys? Please tell me. I'd explain this. Why so? We are deducting the expected return, not the actual return. Okay. So, guys, if actual return on plan assets passes through the income statement, then the interest income would fluctuate with the stock and the bond market. That is, interest income would become very volatile. And if interest income is volatile, then naturally the reported pension expense in P&L would be very volatile. And a volatile pension expense would increase the volatility of the reported earnings in the income statement. And we do not want our earnings to be volatile because investors look at the earnings of the company before investing in it. And if the earnings are volatile, investors will perceive that the company is a risky investment, right? So rather than passing the actual return, we deduct the expected return on plan assets from our interest cost. Now IFRS says that your expected return is the discount rate, and this discount rate is what? Yes, discount rate equals what? Please tell me. What is the discount rate, guys?
Triple A bond yield.
Very good. It is the YTM of AAA corporate bonds, right? And US GAAP, under US GAAP, the company, the employer gets to choose the expected return, right? So interest income in IFRS is opening FVPA into discount rate, and in GAAP, interest income is opening FVPA into expected return, right? Okay. So guys, under IFRS, pension expense in PL is current service costs, current service costs plus past service costs plus interest cost, which is opening PBO plus past service costs into discount rate minus interest income, which is opening FVPA into discount rate, right? Because IFRS says that the discount rate is the expected return. Right? This was the pension expense in P&L under IFRS, and pension expense in P&L under GAAP is current service costs. Right now, past service costs are not reported in the P&L under GAAP. They are initially taken to the OCI. Right. So we won't have past service costs in our P&L under GAAP. So to the current service cost, we add the interest cost, and interest cost is calculated in the same fashion as we do in IFRS. So the calculation of interest cost is the same under GAAP and IFRS, but calculation of interest income is not. It differs, right? Interest income is calculated as opening FVP into expected return, right? So we'll write under GAAP, employer gets to choose the expected return. In IFRS, your expected return is the discount rate, where the discount rate is the current YTM of AAA corporate bonds with a duration that equals our pension plan liabilities. Right. So this is my pension expense in PL under USD. Right. Okay, guys, are we good here? Any doubts up till now? I'm just revising what we had discussed in the past classes. Are we good? कोई doubt? Anil, Kunal, Ashay, किसी का
I'm
कोई?
good, sir.
Okay. Now, guys, by deducting our expected return on plan assets rather than the actual return on plan assets in the income statement, we have deviated from the economic reality. We have deviated from the financial reality because expected return is an assumption, but actual return is the reality, right? We should have deducted the actual return, but we did not because we wanted to reduce the volatility of the earnings reported in the income statement. So we correct for this in the OCI, right? We'll correct for this in the OCI, right? Okay. Now, guys, we'll write down pension expense in OCI. Okay. Under IFRS, pension expense in OCI is reported as remeasurement loss or gain, right? And this remeasurement loss or gain is not amortized. It sits in the OCI till the pension plan is terminated, right? So there are two components of your remeasurement losses and gains. First is, or rather than writing it here, I'll write it here. Pension expense in OCI is known as remeasurement loss or gain. So it's not amortized, it sits in the OCI till the pension plan is settled, till the pension plan is terminated. And it has two components. The first component is actuarial loss or gain. So what is this actuarial loss or gain? Okay, so if the actuaries change an actuarial assumption which causes the PBO to increase, that would be an actuarial loss. And if changes in actuarial assumption cause PBO to decrease, that is an actuarial gain, right? So this is my actuarial loss and gain, right? So the second component is we deduct the difference between actual return into opening FVPA minus expected return into opening FVPA from our actuarial loss, right? So we deduct the difference between the actual return and expected return from our actuarial loss, and this ensures many things. The first thing that ensures is that the effect of expected return is totally removed from the calculation of TPPC, and we no longer deviate from the economic reality, right? Now only actual return would be deducted from my TPPC. Expected returns, the impact of expected returns would be nullified. It would be completely negated, right? Second, basically thing that this would ensure is this particular accounting treatment would ensure is that we no longer deviate from economic reality because the impact of expected return has been completely nullified while calculating the TPPC. And the third thing that it will ensure is the actual return. The actual return, which is an unrealized gain, is reported in the OCI. And this is what OCI is meant for. This is the reason why OCI is created. The purpose of creating the OCI is to report any unrealized gains and losses. So by passing this particular entry through OCI, we are achieving a number of things. This ensures that the expected return is The impact of expected return is completely nullified from the calculation of TPPC. Second thing is ensures is that since the impact of expected return has been completely nullified, we no longer deviate from the financial reality, we no longer deviate from the economic reality. And the actual return, which is an unrealized gain, is reported in the OCI. And this is the purpose of creating OCI. The purpose of OCI is to report unrealized gains and losses. So, with this complicated entry, we've been able to achieve many things, right? We've reduced the volatility of earnings in the income statement. We no longer deviate from the financial reality. And the actual return, which is an unrealized gain, sits in the OCI, and this is what the OCI is meant for, to report unrealized gains and losses. Now, guys, just we'll check how the impact of expected return has been nullified. Right. So my TPPC is what? Pension expense in PNL plus pension expense in OCI. So pension expense in PNL is my current service cost. Pension expense in PNL past service cost plus my interest cost, which is opening PBO plus PSC into discount rate minus interest income, which is opening PBO, opening FVPA into expected return. Expected return is the discount rate here, but let me write it as expected return. And my pension expense in OCI is my actuarial loss minus actual return into opening FVPA minus expected return into opening FVPA. Opening FVPA. Now, guys, this term I can rewrite as follows. Guys, can I write it in this fashion? If I open the brackets, I can write it as minus actual return into opening FVA plus expected return into opening FVP. Guys, can I write it in this fashion? Are we good? Guys, are we good or not?
Yes, sir.
Okay. So if I add the two, if I add the pension expense in PNL and the pension expense in OCI, you will see that the opening FVPA into expected return, these two terms get cancelled, right? Opening FVPA into expected return plus opening FVPA into expected return gets cancelled if I add the pension expense in PNL to the pension expense in OCI, right? These two terms get cancelled, right? And what is left is, guys, my TPPC is my current service cost plus past service cost plus opening PBO plus PSC into discount rate and plus actuarial loss minus actual return into opening FVP. So guys, by passing this entry through my OCI, you can see that the impact of expected return has been totally removed from the calculation of TPPC. Guys, can you see this? Is expected return featuring anywhere in the calculation of TPPC? Please note, guys. Is expected return featuring anywhere now?
No.
No. So we've gained a lot by passing this particular entry through my OCI. Right. The first thing that I have achieved is that I have nullified. I have removed the effect of expected return from the calculation of TPPC. Second thing is that since I've removed the impact of expected return from the calculation of TPPC, uh, we are no longer deviating from the economic reality. Third thing that we have ensured is that the actual return is, which is an unrealized gain, is being reported in the OCI, and that is the very purpose of creation of the OCI, to report unrealized gains and losses, right? So this is the broad idea, and this is your total periodic pension expense, where this is the pension expense in PNL, and this is the pension expense in OCI, right? Guys, are we good? Any doubts here, please? Guys, please tell me. Do you have any doubts, please? किसी के कोई डाउट? कुणाल, आशय, आशय कोई डाउट? कुणाल कोई डाउट? अनिल कोई डाउट? यस नो प्लीज टेल मी.
Yeah, I'm good, sir.
मैं
हाँ कुणाल, कुछ है प्रॉब्लम? नहीं. आशय, कोई
नहीं
प्रॉब्लम? बंद करो, डिस्ट्रैक्ट कर. Okay. So guys, this is my TPPC as per IFRS, and guys, this is my remeasurement gains and losses. It has two components: actuarial loss and the difference between the actual return and expected return. Okay. And guys, one more thing: the actual return is being deducted from my actuarial loss, and the expected return is getting added to my actuarial loss. So if actual return is less than the expected return, then my actuarial losses would, then my remeasurement losses would increase, right? See, please note guys, we can write it in my remeasurement gain and loss. My remeasurement loss is basically what? Actuarial loss minus actual return into opening FVPA plus expected return into opening FVPA. So guys, my expected return is getting added to my actuarial loss, and my actual return is getting deducted from my actuarial loss. So guys, if expected return is greater than actual return, guys, then can I say my remeasurement losses would increase? Guys, can you please tell me? Guys, please tell me. If expected return is greater than the actual return, then my remeasurement losses would increase, right? So say the actuarial loss is 100, expected return is 20, and actual return is less than the expected return, right? So my remeasurement loss would be 110, right? In this case, my expected return is greater than the actual return. However, if expected return is less than the actual return, right? So if my actuarial loss is 100, my actual return is 30, and my expected return is 10, then my remeasurement loss would be how much? 80, right? So if the expected return is greater than the actual return, then remeasurement loss would increase, and if expected return is less than the actual return, then my remeasurement loss would decrease. Guys, are we good here? Have we understood this, please? Yes or no, please tell me, because this is an important point. Bolo. Guys, are we good here?
Good, sir. Good.
आशय, कुणाल, सब गुड है? कोई डाउट है?
नहीं नहीं सर ठीक है गुड टू गो
Okay. Now guys, these remeasurement gains, so I'm talking of IFRS for the time being. So these remeasurement gains are, or losses are not amortized. So whatever pension expense sits in the OCI is not amortized. They sit in the OCI till the pension plan is settled. And when I say pension plan is settled, what I mean is that all pension all pension benefits owed by the plan participants have been paid out, and the pension plan is no longer active, it has been terminated. So these remeasurement losses or gains sit in the OCI till the pension plan is settled. They are not amortized, right? And guys, there is a very big reason behind this. Now we are going to discuss those reasons as well. Okay, because later in IFRS we don't amortize, but in GAAP I will tell you we amortize it due to uh, we amortize it using the corridor approach, right? But in IFRS we won't amortize the remeasurement losses that sit in the OCI. Basically, we won't amortize the pension expense reported in the OCI, pension expense that sits in the OCI. Okay, so guys, this is a very complicated thing. I'll explain this with an example. Kunal सुन रहा है? कुणाल हेलो कुणाल जवाब ही नहीं
हाँ
दे रहा.
हाँ हाँ
कुणाल कोई डाउट हो तो पूछना है.
हाँ हाँ
Okay, so say the company has just initiated a pension plan, right? It has just initiated a pension plan, and in the first year itself there has been a change in the actuarial assumption that causes the PBO to increase by 500, right? So what we do is, in my OCI, which is reported under stockholder equity, I under my remeasurement gain and loss, I record an actuarial loss of 500, right? Why do I record an actuarial loss of 500? Because there has been a change in an actuarial assumption that has caused my PBO to increase, right? Okay. Now, guys, for once, just forget that IFRS tells you that the expected return is the discount rate. Just forget, for the time being, just forget IFRS tells that the expected return is the discount rate, and think that you get to choose the expected return, and you choose you choose an unrealistically high expected return. ठीक है ना? You choose a very high expected return. Say you choose a expected return of 50% per annum on your plan assets, right? So you choose an expected return of 50%. So you say that your stock and bond investments would give you an return of 50% per annum. So you choose an unrealistically high expected return, right? We are for the time being assuming that we've forgotten that IFRS tells you that the expected return is the discount rate. We think that we get to choose our expected return, and we choose an unrealistically high expected return of 50% per annum. Basically, we assume that our stock and bond investments would give us a 50% return per year, right? Which is a very exorbitant, which is very, very unrealistic, right? And guys, the actual return is say 10% per annum, and my opening FVPA is 1000, right? So guys, I'll deduct the actual return from my actuarial loss. So my actual return is how much? 10% of 1000, that is 100, and I'll add the expected return. My expected return is how much? 50% of 1000, that is 500, right? So guys, my opening balance would be 0. Opening balance of remeasurement gains and losses is 0. Why? Because we've just initiated the pension plan. Opening balance is 0 of my remeasurement loss or gain, because we've just initiated my pension plan, right? So guys, my closing balance of remeasurement loss or gain is, remeasurement loss is, I won't have gains here. Remeasurement loss is 500 plus 500 minus 109. right? So this would be my closing balance of remeasurement loss, right? Now let's see, this is year 1, right? Now let's look how next year's OCI would look, right? So year 2, let me write the year 2 here. Now again OCI remeasurement loss. What was the opening balance? What would be the opening balance, guys, of remeasurement loss in year 2? Bolo, guys.
No, sir.
900, right? Okay. Now, guys, next year also we choose an expected return assumption which is unrealistically high, say 50% per annum, right? So my expected return is 50% per annum. My actual return, say now, is 15. So my actual return has increased from 10 to 15, and opening FVPA is, say, 1500, right? So FVP at the beginning of year 2 is 1500, right? And guys, say that in the second year also actuaries changed some assumption which caused the PBO to increase by 800, right? So my actuarial loss is 800. So to the from I'll deduct the actual return. My actual return is how much? 15% of 1500, that is 225, and I'll add the expected return. My expected return is how much? 50% of 1500, which is how much? 750. So guys, calculate the closing balance of remeasurement gains and losses. Ever please calculate this. How much are we getting? Guys, करो ये calculate. Do this like really fast. 900 plus 1800, 1700, 1700, 2450, 2225, right? So this is my closing balance of remeasurement loss, right? So guys, you can see that you can see the idea that we are getting from this example is that if my expected return assumption is unrealistically high, then my actual return would always be less than my expected return. Guys, can you get this idea? I want a yes or a no. If my expected return assumption is unrealistically high, then my actual return would always be less than my if my expected return assumption is unrealistically high, then my actual return would always be less than my expected return. Guys, can we understand this?
Yeah, and closing balance will also be high in that case, right?
Yes, and this will cause my remeasurement loss to keep on increasing year on year, right? So if my expected return assumption is unrealistically high, then my actual return would always be less than my expected return, and this would cause my remeasurement loss to keep on increasing year on year. Guys, can we get this, please? Are we good here? Bolo yes or no. I want a yes or no from everyone.
Good, sir.
Year 1 may, at the end of year 1, my remeasurement loss was 900. At the end of year 2, my remeasurement loss is 2225. Why has this happened? Because my expected result return is unrealistically high than my and if my expected return is unrealistically high, then my actual return would always be less than my expected return, and this would cause the remeasurement loss to grow and grow, right? Okay. Now guys, let's come. आशय कोई डाउट है तुमको? आशय, yes, no?
नहीं सर.
Okay. Now IFRS, guys, now let's come back to the reality. I told you that just forget for the time being that IFRS tells you that the expected return is the discount rate. Now let's come back to reality. IFRS does not allow you to choose the expected return. In IFRS, you can't choose a unrealistically high or an unrealistic low expected return. IFRS says that the expected return is what in IFRS, guys? Bolo? Expected return is, please tell me what is the expected return in IFRS? What does the IFRS tell you that the expected return is what? Ashay, Kunal, Anil, batao, expected return is what figure?
Discount rate.
Yes. IFRS says that the expected return is the discount rate. And this discount rate would be a smaller number. Please tell me why. It would be lower because discount rate is the YTM of AAA
Triple A.
corporate bonds. And
Right.
since AAA corporate bonds have lower credit risk, their YTMs would be very low, right?
Right.
Bonds with higher credit risk have higher YTMs. Bonds with lower credit risk have lower YTMs, right? So higher the risk, higher the return that an investor wants. YTM is what? Basically a return measure that a bondholder or an investor in bond will earn, right? So since these AAA corporate bonds have very low credit risk, their YTMs are very low. So the discount rate is very low, and because the discount rate is very low, expected return would be very low because under IFRS your discount rate is equal to your expected return, right? So IFRS is of the view that since we are using a very low expected return assumption, if currently actual return is lower than the expected return, please listen to me carefully. If currently actual return is less than my expected return, causing my remeasurement loss to increase, later on, this is going to reverse when actual return exceeds the expected return. Why so? Because we are using a very low expected return assumption, right? So if currently I am experiencing a remeasurement loss because my actual return is less than my expected return, later on this is going to reverse. Why? Because I am using a very low expected return assumption, right? I am not choosing an unrealistically high expected return assumption. I am choosing a very low expected return assumption. How am I using a very low expected return assumption? Expected return under IFRS is nothing but the discount rate. Discount rate is the current YTM of AAA corporate bonds. AAA corporate bonds have low credit risk. Since they have low credit risk, their YTMs would be very low. There would be a smaller number, right? So since my discount rate would be a smaller number, my expected return would also be a smaller number. Why? Because under IFRS, discount rate and expected return are equal. Guys, are we good here? Have we understood this? That IFRS is saying that since you are using a very small expected return assumption, if you are currently having remeasurement losses because actual return is less than expected return, later on this is going to reverse when actual return exceeds expected return. Guys, are we good here? Any doubts, please? Yes or no, please tell me. Please, this is a very important point, guys. Please tell me, do you have a doubt or not? आशय, अनिल, कुणाल, मेरे को बताओ.
I'm good, sir.
आशय, तुम बताओ. मेरे को I individually want to hear a yes or no. कुणाल बताओ. आशय बोलो.
नहीं नहीं
Good to go.
Okay. So this is an important concept. बुक में नहीं लिखा हुआ है. बहुत ध्यान से समझा रहा हूँ, इसलिए मैं अंदर से समझा रहा हूँ पूरा. Okay, so these remeasurement gains and losses are not amortized because IFRS says that if you currently have a remeasurement loss, later on you are going to have a equivalent gain uh, because you are using a very low expected return assumption, right? uh, so there is no need to amortize these remeasurement losses or gains because they will self correct, they will auto correct, right? So these remeasurement losses are not amortized, they sit in the OCI. So this is a very important conclusion that we've gathered now. They sit in the OCI. So we've discussed gap, we've discussed IFRS, and what we've discussed till now is that in IFRS, current service costs are expensed in the income statement, past service costs are expensed in the income statement, interest costs are expensed in the income statement. From our interest costs, we deduct the interest income, right? And we had said that the pension expense reported in OCI is known as the remeasurement losses or gain, and these are not amortized in the income statement. Why? Because we are using a very low expected return assumption. If we are currently having remeasurement losses because actual is less than expected return, later on we are going to have remeasurement gains when actual exceeds expected. Right? So this is the broad idea. Now we are going to discuss gap. Now, guys, what IFRS calls, what IFRS calls remeasurement losses, US GAAP calls actuarial loss or gain, right? What IFRS calls remeasurement loss, US GAAP calls actuarial loss or gain. This too is reported in the OCI, right? So pension expense reported in OCI under US GAAP is known as actuarial loss or gain, right? But the components of however, the components are the same as IFRS. The first component is actuarial loss or gain, which is the change in PBO due to change in actuarial assumptions, right? So, if actuarial assumptions increase the PBO, then it's an actuarial loss, and if changes in actuarial assumptions decrease the PBO, it's an actuarial gain. And the second component is the difference between actual return and expected return. Same thing, same as IFRS. Only the name has changed. IFRS called it remeasurement loss, and US GAAP is calling it actuarial loss or gain. Now, GAAP gives you an option, right? GAAP gives you one option. GAAP says that okay, you can report this pension expenses in the PNL or OCI. I give you a choice. You can report these things in PNL or OCI. But typically companies report through OCI and not on the PNL, right? Typically companies would report these expenses in the OCI and amortize it in the income statement when certain conditions are met under the so-called corridor approach, right? So please write this down. This is an important point. These expenses, okay, US GAAP. Likho guys, please give write. I won't write. You write. US GAAP gives you an option to report these three pension expenses in PNL or OCI. Typically, company report these through OCI and amortize it on the income statement when certain conditions are met under the corridor approach. I am
सर वो
repeating.
टिपिकली के आगे क्या बोला था, एक बार फिर से रिपीट करो.
Typically, company report these through OCI and amortize it in the income statement when certain conditions are met under the corridor approach. Okay, guys, why are companies passing these expenses through OCI and not income statement? There is a reason behind this. Again, the reason is the same. They do so to reduce the volatility of the pension expense in the PNL, right? So there is an element of smoothing here. If I pass all these expenses through the PNL, my pension expense in PNL would become volatile. If my pension expense becomes volatile in the PNL, then naturally my earnings, net income reported in the PNL would also become volatile, and investors don't like volatility, right? So that is why we are reporting these expenses through my OCI to curb down the volatility in my income statement. Right. So there is an element of smoothing here. Please write this down. There is an element of smoothing here. Right. These expenses are passed through OCI to curb the volatility of my income statement. ये दो चीज प्लीज लिख लेना बाद में. चलो, we have the video recording. I'll give you the video recording naturally, but we should keep this in mind. Okay. Now, guys, I said that these expenses are amortized in the income statement under the so-called corridor approach, right? So now we'll discuss what the corridor approach is, right? So let's discuss that. Okay, guys, please tell me, uh, do we get to choose the expected return in IFRS? Guys, do we get to choose the expected return in IFRS? Yes, we get. Our expected return is the, we are not given the, we are not allowed to choose the expected return in IFRS. The expected return is my discount rate. But in US GAAP, the employer gets to choose the expected return, right? So unlike IFRS, under US GAAP, the employer gets to choose the expected return. And guys, if the employer chooses an unrealistically high expected return, then what would happen, guys? Please tell me. I just explained this with this example. If the employer chooses an unrealistically high expected return, what would happen to my actuarial gains or losses? Bolo, tell me. Guys, what will happen if the employer chooses a very high expected return? Tell me yes or no, guys. Batao, what will happen? Anil, if the employer chooses an unrealistically high expected return?
This should increase loss.
Yes, the actuarial loss would keep on growing, right? So under IFRS, uh, we were not amortizing the remeasurement gains and losses because we were using a, IFRS was telling me that the expected return is the discount rate, and the discount rate is a very low number because discount rate is my YTM of AAA corporate bonds. AAA corporate bonds have low credit risk, so their YTMs would be low, right? So that is why they were not amortizing remeasurement losses. But here in GAAP, you get to choose, the employer gets to choose the expected return, and if he chooses an unrealistically high expected return, then naturally, as per the example that we just discussed, as per this example, if we choose an unrealistically high expected return, then my actuarial losses would keep on growing, right? They would grow and grow, and they would become very big over the years, right? So if I choose a very high expected return, we saw that uh, my actuarial losses increased from 900 to 2225 over a period of 1 year only, right? So uh, if I choose an unrealistically high expected return, my actuarial losses would keep on growing. They would become very big over the years. So US GAAP says that if actuarial losses are too big, if they are very big, they need to be amortized in the income statement. Please write this. Please write this. If US GAAP says that if the actuarial losses are too big, they need to be amortized in the income statement. And US GAAP uses the corridor approach to ascertain whether the actuarial losses are too big or not. The US GAAP would use the corridor approach to check whether the actuarial losses are too big or not. Guys, any doubts बोलो अभी. I am now going to discuss the corridor approach used in GAAP. कोई doubt है तो बोलो, please. किसी के
I'm
कोई
good, sir.
doubt? आशे कोई डाउट, अनिल कोई डाउट, कुणाल कोई डाउट, सब यस नो मेरे को अभी बोलो.
नहीं सर.
नहीं.
Okay. So what is the corridor approach under? What is the corridor approach under US cap? Okay. Okay, guys. So now the why are we using the corridor approach to check whether my actuarial losses are too big or not? And if we find that my actuarial losses are too big, then I will start amortizing them. Please write this down. We are using the corridor approach in gap to check whether my actuarial losses are too big or not. And if I find that my actuarial losses are too big using the corridor approach, right? If I use the corridor approach and find out that my actuarial losses are too big, I will start amortizing my actuarial losses, right? Okay. So, guys, 10% of the higher of opening PBO or opening FVPA would be my corridor. Guys, so first I'll find the higher of the two numbers, right? And 10% of the higher of the two numbers would be my corridor, right? I'll find the larger of these two numbers, and 10% of the larger number would be my corridor. And if the unamortized actuarial losses that sit in the OCI are greater than the corridor, then I will say that my actuarial losses are very big, right? If my unamortized actuarial losses that sit in the OCI are greater than the corridor, I will say that these actuarial losses are now very big. I have to amortize them. So what do? We amortize the excess. We amortize the excess. Now please note the word excess. We amortize the excess of the actuarial loss over the corridor over the remaining service life of employees. Over the average remaining service life of employees. Right. So I will explain this with an example. ठीक है ना? We'll do this with the help of an example. Right. So guys, say the market value or the fair value of plan assets is 400,000. Right. The opening FVPA is 400,000. Opening PBO is 700,000. Okay, guys. Now we need to calculate 10% of the larger of the two numbers, right? So which one is larger, guys? PBO is larger or FVPA is larger? As PBO is my larger number or FVPA is a larger number? Which one, guys? PBO is a larger number, right? So 10% of the larger number, that is 10% of 700,000, that is 70,000 is my corridor. Right now, if my unamortized actuarial losses in the OCI exceed the corridor, I'll have to start amortization. Right. So now say unamortized actuarial loss is 90,000. Right. Okay. So my corridor is 70,000, and the unamortized actuarial loss in OCI is 90,000. So my unamortized actuarial losses exceed the corridor by how much, guys? My unamortized actuarial losses exceed the corridor by how much? Please tell me.
20,000.
Yes. Unamortized actuarial loss is 90,000 and my corridor is 70,000. Right? So my unamortized actuarial losses exceed the corridor by 90,000 minus 70,000, which is 20,000, right? Now we will have to amortize this 20,000. We will amortize the 20,000 over the average remaining service life of the employees. So say the average remaining service life of the employees is 20 years, right? So we will amortize this 20,000 over 20 years, right? So my we are going to divide this 20,000 by 20, and that would give us how much? 10. That would give us 20,000 by 20, that is going to give us $1,000. So we are going to amortize this $1,000 expense over the 20-year period in the income statement, right? And in the current year income statement, we are going to report an amortized actuarial loss of 1,000, right? We are going to report an amortized actuarial loss of 1,000 in the current year income statement, right? So if my actuarial losses exceed the corridor, my actuarial losses are very big, I need to amortize them. So what we do is we amortize the excess over the average remaining service life of the employees, right? So here my actuarial losses exceeded the corridor by 20,000. So we need to amortize this 20,000 over a period of 20 years, where 20 years is the average remaining service life of the employees. So 20,000 by 20 is 1,000. So we'll amortize 1,000 in the income statement every year for the next 20 years, right? Okay. Guys, are we good here? Any doubts, please? Bolo, yes or no? Guys, tell me yes or no. Do we have any doubts?
Also,
Guys, if my unamortized actuarial loss in OCI were to be 40,000 instead of 90,000, then will there be any need for any amortization? Yes, please tell me. If the unamortized actuarial loss was 40,000 instead of 90,000, do we need amortization? Yes or no, guys? Please tell me. Does the actuarial loss exceed my corridor? Bolo, guys, do my actuarial losses in OCI exceed my corridor right now? Yes or no? Please tell me. Hello, guys. Actuarial loss 40,000 है, corridor 70,000 है. So is the actuarial loss exceeding the corridor?
No, no,
No.
no.
So it's not exceeding the corridor, and since it's not exceeding the corridor, that basically means that the actuarial losses are not big enough for us to start amortization, right? It's only when the actuarial loss is greater than the corridor shall we amortize the actuarial losses in the income statement. If the unamortized actuarial loss in the OCI is less than the corridor, there is no need for any amortization. We would basically say that the actuarial losses are not big enough for us to start any amortization. Guys, are we good here? Any doubts, please? चलो बोलो guys. किसी के कोई डाउट? मन में कोई भी डाउट है तो पूछो guys. Guys बोलो yes no, फिर एक क्वेश्चन
Good,
करें.
sir. Good. Yes, sir. Yes, sir.
उस दिन ये वाला कर रहे थे ना, अब यही निकालो अपने, ये इसमें करेंगे गैप में. ठीक है, यहाँ लिखो IFRS. प्लीज स्क्रॉल डाउन. नाउ यू विल सॉल्व दिस. दिस इज US गैप. बोलो what would be the opening net pension liability under US gap? Is the calculation same in gap and IFRS with respect to the calculation of net pension liability? Is the accounting treatment same, or is there any difference? It's same, guys. Okay, now in gap, where are current service costs reported in gap? in the P&L or in the OCI? बोलो guys, current service cost कहाँ जाएगा?
PNL.
Yes. Past service costs would go to the P&L or OCI under US GAAP.
PNL.
P&L. P&L और OCI US GAAP.
यूएस का PNL ही जाएगा सर, पास सर्विस कॉस्ट.
Past service cost अपने क्या लिखे यहाँ पे? It's initially taken to OCI and then amortized. ठीक है ना? So it goes to the OCI. ठीक है ना? यहाँ नहीं बैठेगा. It goes to the OCI. Interest costs are calculated in the same way as IFRS. So my interest cost is the same. But interest income calculation differs. IFRS says that expected return is my discount rate. But in US GAAP, we get to choose the expected return. So in the question, they must have mentioned the expected return. Please go to the question and tell me what is the expected return. Please go to the question. Just scroll up in WhatsApp. You'll get.
6.55 years.
Hmm?
Just a second.
Question देखो. Please go to that question. What is the expected return assumption given there?
Say 6%.
6%. And what is the opening FVPA? Opening fair value of plan assets?
28,322.
28,322. Right? So this would be deducted. So let me add this in. So my pension expense reported in the P&L under GAAP would be 3065.9. Now let's look at OCI. Okay, so this 619 actuarial loss would go to the OCI, right? Then we'll deduct the actual return and we'll add back the expected return, right? Now expected return here is how much? This opening FVPA into expected return, which is 28322 into 0.6, that is 1699.32. And guys, the past service costs go to OCI in GAAP. So this would be the pension expense in OCI under GAAP, that is 643.32, right? Now we'll calculate the total periodic pension cost. This was in IFRS, this is in GAAP, right? So pension expense in PNL is 3065.9, pension expense in OCI is 643.32. If I add the two, I should get 3709 or round about that figure, right? So I'm getting the same answer, guys, right? I'm getting the same answer. uh, I had rounded this off here, let me unround it, right? So I'm getting the same figure, right? So my TPPC is the same under both IFRS and US GAAP, right? It's only that some pension expenses go in the OCI, some go to PNL. That's what differs in US GAAP and IFRS, right? ठीक है ना guys? And net pension liability at the closing of the year would be 12,937. This would be the same under GAAP and IFRS. Okay. Guys, what are the unamortized actuarial losses? In the question, there must be some unamortized actuarial losses. There must be they have given unamortized actuarial losses. What are that? Please read the question and tell me the unamortized actuarial losses that sit in the OCI.
3150.
Yes, that is 3150. Okay. What is my opening FVPA? That was
28
28322. And what is my opening PBO?
38750.
375.
38 sir. 38750.
3875. So higher of the two numbers is what, guys?
PBO.
PBO. So opening PBO. So my corridor would be 10% of opening PBO because opening PBO is higher than FVPA. So corridor is 10% into 38750. So guys, are my actuarial losses exceeding the corridor?
No.
So I know there. So I will say that my actuarial losses are not large enough for us to start amortization. Right? We won't amortize it because my unamortized actuarial losses are less than my corridor. Had my unamortized actuarial losses been greater than 3875, then we would have said that okay, my actuarial losses have now become very big and I need to do something about it. I need to start amortizing the excess. Right? So that's the broad idea. Guys, are we good? Have we understood everything from today's class? कोई doubt है मन में?
Sir, how did you take 10%? Is it standard or
Yeah, it's the standard. It's the standard. That's what the corridor approach says. ठीक है ना? The 10% of the larger of the two numbers would be my 10% of the higher of the two numbers or the larger of the two numbers would be my corridor, and if the unamortized actuarial loss exceeds the corridor, then my actuarial loss is big now and I have to start amortizing it. However, if the actuarial loss is less than the corridor, then it's okay. My actuarial losses are not that big. There's no need to amortize them in the income statement. ठीक है ना अनिल? So it's the standard
good?
approach, right?
Good, sir.
Which the US gap tells you. It's the rule that the US gap has prescribed. चलो बोलो कोई मन में डाउट गाइस?
Good, sir.
एकदम क्लियर है? कोई डाउट है पेंशन को लेके अभी तक आज तक का?